In this chapter, we'll present information from the business tax return and company-prepared financial statements. Tax income is reconciled to book income, starting with ordinary business income, capturing items reported on Schedule K, that is, income and expense allocated to owners, such as Section 179 deduction, and continuing through Schedule M, which reconciles book versus tax income and expense, such as depreciation, travel and entertainment, among others. Normalization involves the restatement of the historical financial statements to remove the impact of activities outside of regular operations. Examples of adjustments include officer compensation, property rent expense, excess fringe benefits or reimbursements. The balance sheet shows the source and use of capital used to generate revenue and income in each period. We'll focus on assets since the source of capital will change in the acquisition context. We'll summarize the income statement in a cost and income graph to show the operations of the firm throughout each fiscal period. We'll address the cash flows of EBITDA and discretionary earnings. Cash flows differ from income as it recognizes non-cash expenses like depreciation. Cash flow may be calculated before tax or after tax. The balance sheet assets are summarized here with fixed assets shown at net book value, that is, the net of historical cost less accumulated depreciation. A separate appraisal would be required to determine market value. Normalization of the balance sheet could involve the exclusion of assets not required for normal operations, such as personal property, and could involve the adjustment of income or expenses related to that non-operating asset. The cost and income graph summarizes performance for the normalized operations of the existing company in each fiscal period. Fiscal periods may include the fiscal year, year-to-date for the current or prior year, or for the month. A useful tool for evaluating performance is common sizing, where an item is stated as a percent of sales. The development of EBITDA and discretionary earnings are shown. These are before-tax measures. Revenues are sales or receipts as reported in the tax return and exclude income not related to primary business operations, such as income from the sale of business assets. Costs of goods sold shows purchases and other costs. Changes in inventory may also be recognized here. Gross profit reflects the competitive capacity of the firm to pass on changes in cost of goods sold in the marketplace. Officer compensation has been normalized to market rates. Personnel expense may be a combination of salaries and wages, payroll taxes, and other costs. This may vary by accounting practice, and differences in classifications may occur between the year-to-date company-prepared statements and the fiscal year-end tax returns. Occupancy expense has been normalized to market rates. General expenses include costs not classified elsewhere. Business firms are permitted for tax and financial reporting purposes to charge a portion of the cost of fixed assets systematically against annual revenues. This allocation of historical cost over time is called depreciation. Depreciation is reported here as reconciled with tax and book depreciation. Business performance for the existing company in the historical period is summarized in the cost and income structure and the cash flows of EBITDA and discretionary earnings. In this chapter, we discussed information from the business tax return and company-prepared financial statements that are normalized to remove the impact of activities outside of normal operations. We discussed how the balance sheet and income statement were analyzed to develop cash flows. For more information, contact Rainier Business Intelligence.